Welcome to the deep dive. In today's real estate market, we're seeing some truly dynamic shifts,
Mm-hmm.
restrictive senior lending, volatile capital, and just a landscape where, well, traditional financing often isn't cutting it anymore.
Right. Especially for those time-sensitive deals.
Exactly. Or navigating tricky refinancing hurdles. It often leaves you, the real estate professional, feeling like you're, trying to solve a puzzle with missing pieces.
That's a good way to put it.
But what if there was a powerful sort of strategic tool designed specifically for these challenges? This is where I think preferred equity truly shines.
It really does.
So this deep dive is for you. Maybe you're prepping for a critical meeting, catching up on market trends, or just, curious. We want to help you understand how to optimize your capital structure and build more resilient, profitable deals.
Sounds good.
Before we dive in, hit subscribe so you don't miss new episodes. And if you find value, please click the like button. It really helps us reach more people. Okay, let's get started.
Great. Yeah, preferred equity. It isn't just another financial instrument. It's really a critical hybrid solution.
Hybrid, okay.
Yeah, think of it as ingeniously blending the security you typically expect from a debt-like return with some of the upside potential, or at least a very strategic slice of it, that comes with an equity investment.
Interesting mix.
Understanding its mechanics isn't just like academic theory. It's fundamental to thriving in this current economic climate. So our mission today is to really deconstruct this preferred equity model, clarify its unique position, highlight its advantages, and look at some practical real-world applications.
That sounds like that puzzle piece many people are looking for right now. So to really get the value of preferred equity, we first need to understand its place, right? Its place in the pecking order, the capital stack. How do you explain this financial hierarchy for a real estate project? And crucially, where does preferred equity fit in?
Yeah, absolutely. It's often best to visualize it, maybe like a building. Different floors represent different layers of capital.
Okay.
And each floor, each layer, comes with its own level of risk and, well, consequently, a different potential return.
Makes sense.
So at the very bottom, the bedrock, you have senior debt. This is your main mortgage, your primary loan. It's secured directly by the property itself.
Got it. First in line.
First in line, absolutely. First claim on assets, first claim on cash flow. Because it's the safest position, it offers the lowest risk and, naturally, the lowest return. It's really the stable foundation.
Okay. Foundation layer. What's next?
Above that, maybe the first floor, you typically find mezzanine debt. Now, this is a subordinate loan. It sits right behind the senior debt in priority.
Subordinate meaning second place.
Exactly. And what's key here is that mezz debt is often secured differently, not by the property itself, usually, but by a pledge of the ownership interest in the company that owns the property.
Ah, okay. So not the bricks and mortar, but the shares of the owning company.
Precisely. So it's a step up in risk from senior debt and also a step up in potential return.
Okay, foundation, first floor. What's on the second floor?
Now, on the next floor up, this is where preferred equity lives, our focus today. And this is where it gets really interesting because it's not debt, not in the traditional sense. It's a special class of equity ownership.
Equity, but special. How so?
Well, preferred equity holders sit senior to the common equity holders. But, and this is crucial, junior to all the debt. Senior debt, mezzanine debt, any debt.
Okay, so sandwiched between debt and regular equity.
Exactly. Its defining feature is its priority claim on distributions, cash flow, and capital returns over that common equity.
Gotcha. And the top floor.
And finally, yeah, the penthouse suite, if you like. That's common equity. This is the highest risk part of the stack, but it also carries the highest potential return.
The real risk takers.
Typically, yes.
Yeah.
Common equity holders are the very last to get paid. Last from ongoing cash flow, last when the property is sold or refinanced. But, and it's a big but, if the project is a huge success, they keep all the uncapped upside after everyone else, debt holders, preferred equity holders, has been paid what they're owed.
Okay, that clarifies the stack nicely. So preferred equity is essentially bridging this crucial gap, like you said, connecting the relative certainty of debt to the high wire act of common equity.
That's a great analogy.
But what makes it truly unique? What are its core characteristics? What really sets it apart from those other floors?
That's exactly what it does. It bridges that gap. And its defining characteristics, its strengths, are quite distinct. Firstly, there's the priority return.
Priority return, okay.
Preferred equity holders get a predetermined return. It's often a fixed percentage, say 10-15% IRR or something like that. And they get this before any profits go to the common equity holders.
So they get paid first out of any
Out of
profits.
profits, yes. After debt service, of course. It helps de-risk things for everyone, actually. Makes the deal more palatable.
Okay, what else?
Secondly, and this is vitally important, liquidation preference.
Liquidation preference. Sounds serious.
It is, in a protective sense. In the event of a sale or a refi capital event, the preferred equity capital that was invested, plus any accrued unpaid return, must be returned in full, completely, before the common equity holders get anything back.
Wow. So that priority in payment sounds like a huge safety net for the preferred equity investor.
It absolutely is. Significant downside protection.
But does that create friction sometimes? With common equity, I mean.
Hmm.
Or challenge how they structure their own incentives? And what about the flip side? Is the pref equity upside limited then?
You've hit on a really critical point there about alignment. And yes, their upside is typically limited. That's the limited upside characteristic.
Okay.
Unlike common equity, which has that uncapped potential we talked about, the return for preferred equity is usually capped at that agreed-upon rate. Now, that said, some structures can include things like cash flow participation above their hurdle, or maybe an equity kicker.
A kicker, like a bonus.
Sort of, yeah. It allows them a small share in profits after their initial preferred return and capital are fully paid back. It's a way to sweeten the deal, align incentives a bit more closely, but their main focus remains that priority, often fixed, return.
Got it. And you mentioned control earlier.
Right. Control rights. This is a powerful element and very different from typical passive common equity. Preferred equity often comes with significant control rights. Sometimes people call them bad boy provisions, though that term can be a bit loaded.
Okay, so what kind of a control are we talking about?
These rights are usually triggered only if the project underperforms significantly or if the borrower defaults on key terms of the agreement. It's not about day-to-day management, let me be clear on that.
Right, not telling them which color to paint the walls.
Exactly. It's more about protecting the investment. It might give the preferred investor a say in major decisions like selling the property, approving a new budget, changing the business plan, or even, in serious situations, the right to remove the manager or take over control of the entity.
So it's a safety valve.
It's a mechanism, yeah. A way to ensure the preferred investor can step in and protect their capital if the original plan really goes off the rails.
That makes a lot of sense.
Yeah.
Okay, so we've got this sophisticated instrument, preferred equity. But, in the real estate world, choosing the right type of capital for a specific deal, that's absolutely critical.
Crucial.
So to really see where preferred equity shines, let's compare it directly to its closest relatives in that capital stack. Let's start with preferred equity versus common equity. What's the main distinction there, thinking about security and control, and who is each best suited for?
Yeah, good comparison. The core difference between pref and common really boils down to that fundamental trade-off we keep touching on. Security versus that potential for uncapped upside.
Okay.
With preferred equity, as we discussed, it's senior within the equity structure. It gets paid after all the debt. But before common equity, its return profile, usually fixed, often capped, predictable.
Lower risk then. Lower risk, exactly. Thanks to that liquidation preference and the priority distributions. So for investors, this means a more predictable, risk-adjusted return. Plus that crucial downside protection. For borrowers or sponsors, it's really excellent for flexible gap funding without diluting their control nearly as much as bringing in a full common equity partner would.
Okay, so pref is for predictable, protected returns. What about common?
Now, common equity, that's at the other end of the spectrum. It's the most junior position, last to get paid.
Right.
Its return profile is completely uncapped. Common equity holders get all the residual profit after everyone else is satisfied. But this means it's inherently the highest risk. They're the first equity dollars to be lost if the project underperforms.
But they get the control.
Typically, yes. The upside for common equity includes full operational control over the asset, assuming they're hitting their targets. So who is it best for? Investors seeking maximum upside, who are willing and able to take on significant risk. And for sponsors who really want to maintain full operational control over their project.
That distinction is crystal clear. Predictable returns, some protection, negotiated control, versus maximum potential upside with maximum exposure and full control. Okay, now let's tackle its other cousin, mezzanine debt.
Yes.
This is where I think a lot of people get confused because they both often appear in a similar part of the capital stack, filling that gap. But you mentioned their legal and structural nature is fundamentally different. Can you break that down?
Absolutely, and this is such a critical distinction. It can genuinely save a deal or frankly, sink it if you misunderstand it. While both often fill a similar funding gap between senior debt and common equity, their fundamental nature is, well, it pulls apart.
Okay. How so?
Preferred equity is, at its core, an equity investment. It's an ownership stake, albeit a special class, in the property-owning entity.
Right. You said it's not debt.
Exactly.
Hmm.
Because it's equity, there's usually no direct loan filed against the real estate itself.
Mm-hmm.
And security comes purely from its priority position defined within the LLC operating agreement or partnership agreement.
So the security is contractual within the company structure.
Precisely. If things go wrong, the remedies for the pref investor involve things like taking control of the entity or forcing a sale, but all governed by the terms of that operating agreement. And importantly, the documentation is usually contained within that single operating agreement. This generally makes it faster and less complex to structure and close.
Faster and simpler sounds good.
It often is. This makes preferred equity ideal for situations demanding speed and simplicity. And critically, it's often used when a senior lender might actually prohibit additional subordinate debt, which is quite common these days. Pref equity isn't debt, so it can sometimes sidestep that restriction.
Ah, that's a key point. So how does mezzanine debt compare then?
In stark contrast, mezzanine debt is a traditional loan. It's debt, plain and simple.
Okay.
Its security is typically a pledge of the ownership interests in the borrowing entity, similar to how pref equity's position is defined, but the remedy is different. If there's a default, the mezz lender can foreclose on those ownership interests. This is usually done through a process called a UCC foreclosure.
UCC foreclosure. Sounds complex.
It can be quite complex and potentially time-consuming, depending on the jurisdiction and the situation. And from a documentation standpoint, mezzanine debt always requires something called an intercreditor agreement with a senior lender.
Intercreditor agreement.
Yes. This is a separate, often lengthy legal document that dictates how the senior lender and the mezzanine lender will interact, especially in default scenarios. Who gets paid when, who controls the foreclosure process, things like that. Negotiating these intercreditor agreements can be notoriously difficult and slow. It can often add weeks, even months, to a deal timeline.
Wow. Okay. So that adds significant time and complexity.
It really can. So mezzanine debt is often best suited for maybe larger, more highly structured transactions, where the lender specifically wants the security and the specific remedies associated with a formal debt instrument, and where the parties have the time and resources to negotiate that intercreditor piece. The legal and practical differences are significant. They impact speed, cost, complexity, and the relationship with the senior lender.
That breakdown is incredibly helpful. It really highlights the differences. It sounds like preferred equity offers a level of maybe agility and simplicity that could be a real game changer in today's fast-moving market.
I think that's fair to say, yes.
So, okay, let's bring this down to earth. What does this all mean for you, the listener, in the real world? What are the practical situations, the applications where preferred equity really makes a tangible difference?
Right, the practical side. Well, it truly is a versatile instrument, a bit like a surgical tool for your capital structure. One of its primary uses is bridging the financing gap in acquisitions.
Okay, explain that.
In today's market, senior lenders are often quite conservative, right? They might only offer, say, 60% loan-to-value, or LTV. Let's say a sponsor, the developer or buyer, brings in 20% in common equity. That still leaves a 20% gap in the funding needed to buy the property.
The missing piece.
Exactly. Preferred equity can step in and flawlessly fill that remaining 20% gap. This allows the deal to actually close. Without it, the sponsor might need to find much more expensive common equity, or worse, risk losing the opportunity entirely to a competitor who can bridge that gap.
So it saves deals that might otherwise die on the vine due to conservative lending.
Precisely. Another really powerful use case is funding value add and repositioning strategies.
Value add, like renovations.
Exactly. Imagine an office building, maybe in a prime London district, that needs, say, £5 million for modernization to attract higher-paying tenants and increase its value. If the sponsor's existing capital is tied up, or they don't want to make a dilutive capital call to their existing partners.
Right. Asking existing investors for more money isn't always popular.
Not always. Preferred equity can provide that £5 million specifically for those improvements. Then, the preferred return gets paid from the improved cash flow once the renovations are done and the asset stabilizes. It enhances the asset's value without that painful dilutive capital call.
That's a smart play. You're using it to unlock value, grow the asset's potential, but without giving up potentially more of the ownership pie than you absolutely have to.
Precisely. And that leads directly to another crucial application, one that's especially relevant right now in this higher interest rate environment: navigating complex refinancing scenarios.
Ah, the refi crunch.
Exactly. Consider a $50 million loan on a commercial asset that's maturing. Time to refinance. But because interest rates are much higher now than when the original loan was taken out, the new senior loan offered might only be £40 million. The property value might support more, but the debt service coverage ratios don't work at the higher rate for a larger loan.
Leaving a $10 million hole.
A $10 million shortfall, exactly. A preferred equity infusion of that £10 million can perfectly bridge that gap. It allows the sponsor to successfully complete the refinancing, crucially avoid default, and retain ownership of the asset. This is a very, very common and highly effective use case we're seeing a lot in the current preferred equity UK market, for instance. I've personally seen this specific structure save deals that looked, frankly, dead in the water just months ago.
Wow. A real lifesaver in those situations. What else?
Finally, it's also excellent for facilitating partner buyouts and providing liquidity.
Buying out a partner.
Yeah. Imagine you're in a partnership and one partner needs or wants to exit the investment before the planned hold period is up. Finding the cash to buy them out can be tricky. Preferred equity can provide the necessary liquidity to buy out that exiting partner cleanly.
Instead of having to sell the whole property early?
Exactly. It's often a much cleaner, faster, and strategically better solution than prematurely selling the entire asset, potentially at a bad time in the market, or attempting a full, complicated recapitalization of the whole deal. It preserves the integrity of the original investment plan for the remaining partners.
It's clear that preferred equity can be incredibly useful in so many scenarios. But, a successful pref equity deal isn't just about finding the money. It sounds like it's really about the meticulous agreement, the terms that underpin it.
Oh, absolutely.
What are some of those critical terms and protections that investors and sponsors, too, really need to focus on to make sure it's a strong, aligned partnership?
You're absolutely right. The devil, as they say, is always in the details of the operating agreement or the pref equity documents. From the investor's perspective, things like non-subordination clauses are absolutely vital.
Non-subordination, meaning
Meaning it prevents the sponsor, the borrower, from placing any new debt or maybe another layer of equity that would sit senior to or even on par with the existing preferred equity position without getting the pref investor's explicit consent first.
so it protects their place in line.
It safeguards their priority in the capital stack, protects their original investment thesis. Then there are the control rights, which we touched on earlier.
The safety valve stuff.
Exactly. These aren't about micromanaging day-to-day operations, let's reiterate that, but they are crucial protective measures. They typically only trigger upon a default on the loan or the pref terms, or if the project seriously fails to meet specific, pre-agreed performance milestones like leasing targets or completion deadlines.
And what can those rights include?
They can range quite widely depending on the negotiation, but might include the right to approve or reject major decisions like a sale or refinancing, the right to approve annual budgets, or, in more severe cases, the ability to remove the manager or general partner, or even force a sale of the asset to get their capital back. It's about having a clearly defined safety net, a path to protect their capital if things really veer off course.
And what about the sponsor? What should they look out for?
Well, besides negotiating reasonable terms on those control rights, it's equally important for the sponsor to conduct rigorous due diligence on their capital partner.
Vet the investor, too.
Absolutely. Make sure the preferred equity provider has a reasonable track record, that they genuinely understand the realities and timelines of real estate operations, and that they seem like partners who will work with you through challenges, not just rigidly dictate terms when the first bump in the road appears. It truly needs to be structured as a partnership, even with these protections in place.
That's fascinating advice, focusing on the relationship aspect, too. It highlights how careful structuring can mitigate risk, but also foster a true partnership. What's also really fascinating here, I think, is how the current macroeconomic environment seems to have created almost like a perfect storm, an ideal scenario for preferred equity to thrive. Why is it such a premier option right now, specifically?
It truly is a confluence of several powerful factors that have elevated preferred equity standing immensely right now. Firstly, as we touched on, expensive senior debt.
Rates are high.
Exactly. With central bank rates hitting multi-year highs, the cost of basic senior mortgage debt has soared. This makes it significantly harder for deals, especially new acquisitions or developments, to generate positive leverage, meaning the cost of borrowing is higher than the initial yield the property generates. This naturally increases the need for less expensive, more flexible capital like preferred equity to fill that middle part of the stack effectively. Sponsors are actively looking for alternatives to just piling on more expensive senior debt.
Makes sense. What else?
Secondly, related to that, is lender conservatism. Banks and other traditional lenders haven't just raised rates. They've also significantly tightened their underwriting standards.
They're being more cautious.
Much more cautious. They're reducing leverage across the board. That means they're lending less money against the same asset values compared to a couple of years ago. This directly creates those larger funding gaps in deals that we talked about. Preferred equity is perfectly positioned structurally to bridge these gaps, often more simply and quickly than mezzanine debt, especially given the intercreditor issues.
So bigger gaps needing to be filled.
Exactly. And finally, from the investor side, it offers really attractive risk-adjusted returns.
The sweet spot.
Kind of a sweet spot, yeah. In today's uncertain market, preferred equity provides investors the opportunity to achieve potentially double-digit returns, often structured to feel somewhat debt-like in their consistency, but without taking on the full, uncapped, first loss risk of a common equity position.
So better returns than senior debt, less risk than common equity.
That's the target profile. This combination of yield and a degree of capital protection through the priority return and liquidation preference is incredibly appealing to many investors right now who are cautious about overall market volatility. And we're seeing this play out. There's significant activity in the preferred equity market globally, and particularly, for example, in the UK market, especially in sectors like purpose-built student accommodation, PBSA, logistics, and also office to residential conversions, all areas that require pretty substantial capital for development or major repositioning, and where senior lenders are just being more cautious with their loan amounts right now.
So putting it all together, it seems preferred equity is really much more than just gap financing. It's genuinely a sophisticated instrument for strategic value creation.
I absolutely agree. It's moved beyond just being a gap filler.
It clearly sounds like a tool that should be in every serious real estate player's arsenal, especially in this kind of market.
Absolutely. Think about the dual benefit. For investors, it can deliver attractive, relatively protected returns in what's undeniably a challenging market, that sweet spot we mentioned. And for sponsors and developers, it provides that crucial, flexible capital they need to actually execute their business plans, even when traditional lending is constrained. It allows them to seize opportunities they might otherwise have to pass up. Mastering this tool's really understanding its nuances within the capital structure, knowing how to negotiate those critical control rights and non-subordination clauses. It truly provides a distinct competitive advantage today. It allows you to build more resilient portfolios and, frankly, close more ambitious deals.
That's a powerful takeaway. Okay, so for you, our listener, thinking about how to apply this, here are maybe some actionable insights to consider, building on what we've discussed. First, assess your capital stack on every single deal. Really analyze it. Identify precisely where preferred equity could strategically replace more expensive or perhaps more restrictive forms of capital. Could it improve your overall cost of capital or give you more flexibility?
Good starting point.
Second, if you're on the investing side, prioritize structure. When you're negotiating a preferred equity investment, focus intently on getting robust liquidation preference, clear and fair control rights, and strong non-subordination clauses. These are your key protections.
Absolutely critical terms.
Third, think about leveraging for growth. Don't just think of pref equity defensively, like for refinancing rescue. Think proactively. How can you use it to fund new acquisitions you might not otherwise be able to reach? To drive those value-add projects? Or even to facilitate strategic partner buyouts? It can turn capital constraints into genuine growth opportunities.
Use it offensively, not just defensively. Good point.
And finally, something maybe less tangible but just as important. Build relationships. The best preferred equity opportunities, both for sponsors seeking capital and investors looking for deals, often come through established networks. So cultivate those relationships with experienced capital providers, with knowledgeable advisors, with brokers who really understand this specific niche of the market.
Relationships are key in this space. It's not purely transactional.
Definitely. Well, this has been incredibly insightful.
Glad we could cover it.
Thanks for listening, everyone. If this deep dive helped you or just made you think, please hit that like button. It really shows us this content matters and helps others find it. And definitely tap subscribe if you haven't yet so you don't miss our next one. See you next time.